Hello, good afternoon, ladies and gentlemen. Thanks for joining us today. We are now kicking off the panel discussion titled Private Debt Investments, Evaluating Opportunities. The session today is moderated by Sunil Dal. Sunil is Chief Investment Officer at Bansali Equities in the UAE. Sunil, I'll hand it over to you and then you can introduce the panelists and
Sure.
we can kick off the session. Thanks, Sunil.
Sure. Thanks a lot, Alex. Good morning, good afternoon, good evening for all the attendees globally. It's a pleasure and thanks, Mohammed, for organizing this panel. My name is Sunil Dal and I work as a CIO with a single family office based in Dubai. And we have an office in New York as well. And we've been investing in private debt for a couple of years now. And it's a pleasure to welcome Ali, Ashish, and Michael on the panel. And I would want all of you to introduce yourself briefly. Over to you, Ali.
Hi, my name is Ali Asghar Tambawala. I run a single family office for an Emirati gentleman based in Dubai. And we allocate capital in public and private markets, and private credit has been a focus for the last a couple of years, actually 4 years.
Thanks, Ali. Ashish, you want to go next?
Hi, everyone. I'm Ashish Misra. I am the CIO for a family office based here in the UK and Europe. I invest in multi-manager, multi-asset, multi-manager solutions globally across asset classes. Private credit is something we have looked at. I'm not yet entirely convinced of the merits of that asset class yet, but I'm hoping for that to change over the course of this call.
Thanks, Ashish. Michael?
Thank you very much, Sunil. My name is Michael Watson. I'm Head of Distribution Asia Pacific with La Trobe Financial. La Trobe Financial is a credit specialist fund manager. We've got about $16 billion in assets under management, including our $5 billion La Trobe Australian Credit Fund. So we operate as an asset class specialist here in Australia.
Thanks, Michael. All the participants, please feel free to send in the questions. We'll try to answer them during the session itself. And in case we overrun it, we'll get back to you with the questions. So Ali, why don't we start with you? And the question to you would be, why private debt? And what's been your experience of investing in private debt? And what % of the portfolio that would be?
Yeah, so we started to look at private debt essentially through managers, and that was in 2016. Coming out of the GFC, the private market became a little bit of an abandoned market by the banks. Small, medium-sized enterprises who couldn't get a bond rating or couldn't get access to the public markets, and who traditionally went to banks, whether it was mostly in Europe and in the US, started to essentially look for private capital. So we committed to a few managers in that space, and mostly in the middle market segment, in the small, medium-sized enterprises segment, both in Europe and the US. And those yields compared to the public market yields in 2016 were comparable. Well, you could get a pickup of about 200 to 300 basis points, because those loans are priced LIBOR plus 9 and over. While in the public market, those yields were not available at that. And the experience has been rather good, both in the European private market and in the US. We committed capital only for during the first 3 years of that program, so essentially 2016, 17, 18. After which we saw too much capital flowing in there, and the competition for deals became, things that you were pricing at LIBOR plus 9 and 10 or 11 even, those yields started to come off, and the high side became LIBOR plus 9 was the high side, and the risk commensurately went up. And that's our experience. Those fund managers have continued to do well. The DPIs in those funds are, for for those vintages, the 16, 17, 18 vintages are in anywhere between 0.4 to 0.6 times. So they've returned 40 to 60% of our capital, and they continue to clip well. And they've done well. They've backed good businesses, and even post-COVID, they have been able to manage that risk rather well.
Thanks a lot for the views, Ali. Ashish, you are a guru of studying the credit cycles and the interest rate movements. Today, when we look at it, we get two schools of thoughts. One is saying that, if you look at the credit binge that has happened since the GFC, this is going to end badly. And while there's another class which says that, this party will continue till 2023 or even beyond. So is it a case of glass half full, or is it a case of glass half empty?
I think it's a case of glass filled to unknown quantity at this time. And I'll tell you why I think that. If you cast your mind back, say 4 or 5 decades, the then sort of innovation in investment solutions was emerging markets. And the reason that happened was because baby boomers were hitting the sort of their stride in terms of earnings capacity, savings were ballooning, not enough market capacity in developed markets to absorb that savings. So that's where a sort of second front was opened up in emerging markets. And you saw how that asset class weathered the tequila crisis of the 80s or the Asian crisis of the 90s. You had a similar innovation in alternative strategies, hedge funds, absolute return funds in the 90s. And they came to their sort of acid test in 2000. The thing to watch with the credit cycle, you're absolutely right. We are at or very close to a very important peak in the debt cycle. But the thing to watch for is, how does this asset class, how do these investment strategies perform the next time you have a significant market dislocation event? Bear in mind that this asset class is really, it has been around for about 2 or 3 decades, but it's really only come into its own since after the great financial crisis, the GFC of 2008. So I think the jury is still out on just how full or how empty this glass is. And that answer will probably crystallize over the course of the next few years to see how it performs at the next crisis.
Excellent views, Ashish. Thanks a lot. Moving on to you, Michael. Do you want to give us a landscape of the private debt market in Australia? For a lot of us in the Middle East, our primary focus has always been North America and Europe. But we know that Australia has been one of the best performing economies for the past 20 years without any recession. So any landscape on the debt market, the growth, and particularly your firm, you guys run one of the biggest funds with $5 billion. So any color on that as well?
Wonderful, absolutely. No, thank you, Sunil. Very good question. You're right. Australia did have in the order of 26 or 27 years of uninterrupted economic growth. We've only now had our first recession, with the last 2 quarters being of negative growth. And it would appear to be that we will come out of that very shortly. Obviously, we've fallen off some 7%, and it's projected that we will go forward from a GDP perspective shortly. It's a very broad and deep asset class in Australia. Now, it's possibly not as developed, if you like, as, say, the European or North American markets. And La Trobe works within the subset of secured property credit. So if you like, La Trobe Financial is writing loans to borrowers secured by mortgages over property, but we're not a bank ourselves. But we are originating those assets. They're high credit quality assets, building portfolios, building opportunities for investors to participate in the yield that is available in that non-bank space in the private debt arena. Obviously, private debt in all jurisdictions, ranges from your infrastructure right up to venture capital up the other side. So where do we sit? Well, there's banks, then you've got your non-bank lenders, and further up the risk chain again. We are, if you like, right next to where the banks are along the risk curve. In the Australian context, the non-bank market has some really significant tailwinds at this moment in time. There's been a number of structural moves within the Australian market in recent years. We've had, you may have seen, a Royal Commission into banking in the last year or two. We've had structural tightening by the regulators for for about 20 years, but more focused in the last sort of 4 or 5 years as our property market was starting to run hot. All of this has made it, that with increased capital requirements for banks, which is a global phenomenon presently. And what you're seeing is an emergence of non-bank lenders like a La Trobe Financial. La Trobe, for what it's worth, has been in the market actively since 1952. So we have quite a long history in the private debt space here in Australia. But we are seeing, and no doubt you're seeing it around the world as well, we are seeing an emergence of private debt fund managers and capital raisings as well. So in short, in the Australian context, there is yield. Now that's really the important thing. I mean, in the La Trobe example, that credit fund that we run, which is the highest rated credit fund in Australia, the most diversified, has a range of opportunities ranging from around 1.3% up to about 8% per annum. We also issue RMBS notes from time to time. We more recently issued a $500 million raising in September. And investors in that were earning in the order of 100 basis points and 195 basis points over and above the bank bill swap rate. That was significantly oversubscribed through local and overseas banks, fund managers and the like. So there's a demand for the assets, there's a demand for the income, of course, and there's an acknowledgement that Australia structurally has a very resilient property market and a very resilient economy.
Thanks a lot, Michael. Moving on now, when we look at the private debt market globally, right? So we got North America, we got Europe, we got Asia. Now, some of the key determinants of the market would be, things like good bankruptcy laws, collateral, how quickly can you encash that collateral, the history of the market, and so on and so forth. So here, a question to all of you, starting with Ali. Ali, which are the markets that you guys are more inclined, and which are the markets that you guys avoid?
So we're focused mainly in Europe and the US. Like I mentioned, all our funds, all our managers are Europe and US focused. And precisely why you said what you said, the very well structured markets, these structures are robust, regulatory wise, enforcement wise. And, in 2016, 17, 18, you could still put decent governance into those structures. And so you had a lot of protection, and you can enforce and you can take over assets. And, while the market has heated up, those covenant-like lending has from not just the public market, that has seeped into the private market as well, just because of competition. So, the borrowers, savvy borrowers go to guys who will give them lower covenant thresholds. And so that in the European and the US market, that's also a part of the risk, of the rising risk that's there. So we don't look at Asia, we don't look at emerging markets. And our reason to go into the US and Europe was because the yields in the public market were just not there. And just to enhance that yield with all the protections and comfort that those markets give us.
Thanks, Ali. Ashish, you got anything to add to it?
I just had a question for Ali. In conversations with the managers who run these mandates and strategies for you, what are you hearing them say in regards to the change in the political backdrop? I know for a fact, well, certainly in UK and large parts of Europe, the government is announcing things like mortgage holidays and a moratorium on, reclaiming or, claiming back the asset against a non-performing or a distressed borrower, because in the times the times that we live in, that is politically, optically, visually expedient. Is that affecting how you view the regulatory infrastructure in the US and UK and Europe in regards to ease of, claiming back security and monetizing and releasing the value of the asset of a distressed borrower?
So, I mean, this is all post-COVID, right? So all these are all things that essentially happened or are happening post-March. In some of the managers, and we've had multiple calls with these managers since that, because as you know, all managers have tried to, give the LPs as much information as possible post-COVID. They have worked with with their borrowers to extend and to give extensions in terms of term and in extensions in terms of moratoriums on interest, with the catch up at the end. So in most cases, they're actually working with the borrowers, which makes sense. And that doesn't mean that the enforcement ability has been diminished. These are folks that they foster long-term relationships with, and a lot of these, because these are bilateral agreements and bilateral contracts, they either they're working with them, or they've known them for a long period of time. They know the company, they know the management, and they work with them more as partners rather than just capital, because that's when they need to refinance in the future or pay down debt, or they need new capital for expansion. These are the folks that they reach out to first, and so I don't think that those are issues that they have highlighted to us, the managers, in these calls. What they have highlighted is that some business models have had to adjust, and they are adjusting their terms and the tenors and moratoriums on the short term to account for the adjustments in the business model, and with catch-ups at the end. But the agreements and the contracts and the terms of the lending have not changed, or the enforcement have not changed, and that continues to be the case. They're just working with their lenders better.
Thanks.
Thanks, Ali. Thanks, Ashish. Michael, moving on to you, how do you see the regulation and the groundwork in Australia as far as the private debt is concerned? And secondly, when we are looking at sectors today, particularly after the pandemic, certain industries have been decimated more or been hit much harder than others. Things like retail, things like airlines, which were quite a big part of at least the economy in Dubai. They're going to take a lot of time to recover, if at all. So coming to Australia, coming to your firm, where are the opportunities that you guys are seeing in, and what type of opportunities are you seeing? Is it more like middle markets? Is it more like distress? And if you want to give us any color on that.
Okay, absolutely. Look, great question. There's quite a lot to unpick in that, if I'm honest. Going back to just Ali's response just a moment ago, to lead the Australian context into that, to answer that question, we also in Australia have a very similar forbearance style facility where it's actually ingrained into our responsible lending laws to offer borrowers who are in hardship a repayment holiday, if you like, where they have 3 to 6 months to restore their position, where they can demonstrate that they have a way forward. If someone's in arrears and this simply because they're in arrears, well, in that case, you can foreclose as the lender. If someone can demonstrate that COVID-19 has affected their business and that all things being equal, in a period of time, they can restore their position again, then we are obliged under responsible lending guidelines to offer them that forbearance. In the Australian context, Certainly within La Trobe, we saw our fund forbearance levels increase from sort of 0% to around 14% in May, and that's come down very much organically to around 4.1% of our portfolio as at the end of September. So we've seen an orderly restoring of borrower behaviour, which is good. That's broadly in line with the rest of the market. We have probably returned to order faster than our counterparts, but the market generally has restored itself quite well, and that points towards an underlying systemic strength in the Australian lending industry and economy. You are right. Areas like food and hospitality, airlines, general services, gyms and lifestyle were absolutely hit the hardest here in Australia, whereas some areas such as construction, mining, financials have actually had net, have actually increased their employment reach over this period as well as, and a forecast to continue to do so. I think that now airlines are a special case and they will take some time to get back. Obviously, there's been such distress in that sector. But what is pleasing is that, if you like, obviously not being in that industry, in those industries myself, but the industries which have been affected the most are those which are probably more able to switch back on quickly. Cafes reopen, gyms reopen, these sorts of things, and that sector, broadly speaking, can revive itself faster than an airline, for example, which is a multi-year sort of a strategy. In terms of the opportunities coming out of the market within the Australian context, absolutely, as you see, you can see where the weak points are. You can see where the structurally strong areas are in the economy, as I've mentioned. Again, it's such a broad asset. It's such a broad sector generally. There are different opportunities at different risk levels all the way through, really. It's just a matter of finding that sweet spot that suits your risk appetite and where you feel the best returns there can be gained. But certainly right across the spectrum opportunity.
Thanks a lot, Michael, for those insightful views. Now, when we talk about risk and return are basically two sides of the same coin. You want higher returns, you probably want to move up the risk curve, and you want lower returns, you probably will be taking lesser of a risk. Now, as far as risk is concerned in private debt, so basically we talking about like the risk of rule of law, collateral risk, duration risk, and various other kind of risks. So Ali, what are the top 2 or 3 risks that you would be looking at while investing in private debt, either through the funds or direct investments?
So yeah, we try to mitigate regulatory risk by just staying in markets that have good resolution mechanisms and proven long track records for that. And that's mostly Europe and US. The other risk that we try to mitigate is the fund manager risk, essentially how they're going to deploy this capital, the strategy, and the experience of that team. I mean, we're not backing or we're not allocating to managers who are using leverage, who are trading public market and secondaries. We're only working with managers who have long-term relationships with these folks through their other practices and have and just pure lending relationships, and mostly not. A lot of the European managers are lending to medium-sized enterprises and engineering firms in Germany, or other businesses in France and in Spain and those kinds of jurisdictions where you don't have the regulatory issue, and they have good relationships with these borrowers. And even on the real estate side, like we was speaking to a manager yesterday who some of his borrowers are office space in the US, where you would think that with COVID and post-COVID, that those office spaces are empty, and there's going to be a lot of forbearance in that. There has been that in different cities like New York, San Francisco, things like that. But in Dallas or in Texas or in Tennessee, the secondary markets, actually that office space has become more valuable, and the forbearance had been only for a couple of months, and they're now back on track. And so those are the risks, and those are the main two risks that we sort of try to mitigate. And we also want to work with managers who essentially stay in their lane. They're not trying to do something different. These guys are not fund 1 or fund 2. They've done, this is usually fund 3 and fund 4 that we commit to, where we've already seen that team essentially execute that strategy over 2 funds and have executed usually and have completely exited and returned all the capital for fund 1, and they've raised fund 3, and that's where we've participated. And the team remains the same. The consistency of that track record remains the same. The strategy remains the same. Those are the main risks.
Interesting views, Ali, and I couldn't agree more with you. You probably want to go with someone who's got an established track record, which even Michael will agree with. And Ashish, you being a student of economic history, and
sorry, Sunil, let me just. Sorry. So when you say that, I just had another comment that I missed out. Is even like a manager like a Goldman, right, who did this huge European West Street $15 billion fund recently. We're an LP with Goldman in other assets, in other private market, private equity and secondaries. But even though they're a large player, well established, but this is their first fund in that space. And first funds, well, like it's too big for a first fund, first of all, in my view, and you don't have a track record. So we wouldn't allocate to even a Goldman private equity in a first fund. It just doesn't make any sense to us, at least, because even if it's a Carlyle or who have a track record in other parts of their business, but not in this.
Excellent views, Ali, and that's exactly the question which I was going to ask Ashish, who is an expert in identifying booms and busts. So this morning there was an article in Financial Times that asset managers are in a $300 billion drive to build private lending funds, and some prominent names in there were Oaktree Capital, who are having an excellent track record, Mark Howards, and then you had Goldman Sachs, which initially was looking to raise $5 to $10 billion, but now are upping it up to $15 billion because of the demand. So Ashish, are these a signs of bubble, or how would you read that?
Tricky question, Sunil. Good one, but a tricky one. It's like that senator or congresswoman who I think 20 or 30 years ago said, I can't think of a legally robust definition of pornography, but I know it when I see it. It's the same thing with bubbles. It's very hard to actually define technically what constitutes a bubble. But you do, when something walks like a duck and talks like a duck, it usually is a duck. Are we there yet? I don't think so. Are we getting there? The signs certainly seem to point in that direction. You just cast your mind back to what has happened in the last 4 or 5 years. Some of the key drivers of the growth in the private debt space have been regulatory changes, particularly on the back of GFC. So the Dodd-Frank Act, for example, the Volcker Rule, and over here in Europe as well, and the UK, of course. A lot of new prudential regulation came out, which restricted the ability of traditional high street banks to actively participate in the space, which is what created this opportunity. Now with 4 years of the Trump presidency and a lot of rollback on things like Dodd-Frank, it seems to be that Main Street, more conventional banking entities are piling back into the scrum. Like Ali said a while back, that there are signs of overcapacity and a lack of pricing power, and the spreads are sort of starting to constrict. where originally you might have had 11, 12, 13% spreads. Now 9 seems to be 900 basis points seems to be the top end of this sort of spread spectrum. So the signs are there that there is overcapacity, and there is probably the beginnings of a crowding of this trade. But is it over? Not by a long chalk, not yet, I don't think.
Excellent. Ashish, since we have touched the 30-minute mark and there are no questions, I will let Michael have the last views and the closing thoughts.
Well, thank you very much, Sunil. I really have enjoyed this conversation. I think we've covered quite a lot of territory. I think some of the important takeaways are just how this sector is growing. This sector has some definite tailwinds behind it, locally here in Australia, but also globally. They're economic tailwinds, they're structural tailwinds, they're political and other as well. And in this low yield world that we are in at present, property credit, or private debt, I should say, gives such a better yield premium, or does give that yield premium that traditional fixed income cannot. So as that low rate environment that we are in continues, and is set to continue for some time, you can expect to see some, more investors looking towards it as opportunities, but also more fund managers and managers broadly coming into the space. As we see that pendulum swing back from traditional lenders to non-traditional lenders, as happens across the cycle and as always happens. So some really good thoughts from the panel, and I really do thank you for having me here this afternoon.
Thanks a lot, Michael, for your views. I would like to thank Ali, I would like to thank Ashish, Michael, and Alex and Mohammad Duech for giving us the opportunity to be on this panel. Over to you, Alex.
Thank you very much, Sunil, for moderating the session today. And thanks to our panelists, Michael, Ashish, and Ali.